So we just released a report revisiting the future of office, our first focus report that looks in depth into a topic globally. I'm joined here by Heidi Hanna, who covers office for North America, Chris Saras, who covers office in Europe, and Dennis Wong, who with his colleagues covers the office sector in Asia Pacific. Heidi, why are we revisiting the future of office now?
The recent media attention around office defaults in the US and the broader range of pricing brings the sector fate into focus. And we think it's a good time to look back and check in on our forecast assumptions and views on global variations. Since the start of the pandemic, we have analyzed the office sector, or you can say the future of office. In our mid-year 2020 ISA, we said that demand for flexibility in the office sector would represent a growing part of the market. Yet this would take considerable amount of time to play out, given long-term lease structures compared to other property types. We further analyzed the sector in our ISA 2021. We assessed risks on various metrics like return to office tendencies and fundamentals. Our assessment put US gateway CBDs at the most risk, Japan and China at the least, and Europe in the middle. These are consistent with how trends played out over the last 2 years and how we see the office market today. An updated version of our assessment table is included on page 14 of this report. Finally, one of our key themes in the most recent ISA 2023 was the balance of virtual and in-person interactions in the post-pandemic state.
So on that theme of global variation, one of the big differences that we see globally is just around how strong the return to office is. What is the balance between people working from home and working from an office? Dennis, can you comment on how that return to office is in Asia Pacific and how that compares to the rest of the world?
Sure. In Asia Pacific, office workers have shown a relatively strong willingness to return to office. If you look at the return to office ratios in major office markets such as Tokyo, Singapore, and Seoul, they are close to pre-pandemic levels today. Even in Shanghai, the return to office ratio has rebounded sharply now that the COVID restrictions are behind us. That said, there's still variation within Asia Pacific due to the differences in culture and local dynamics. For instance, the return of office in Australia continues to lag the region, and that is because Australian workers have adopted flexible working arrangement more readily than others. And broadly, in the global context, Asia Pacific is leading the return to office, with Europe being in the middle and North America lagging the two regions.
Right. So Europe in the middle, US weakest return, Asia the highest return, generally speaking, but a lot of sort of caveats and exceptions and variation around that. So another big difference globally is the starting point in terms of occupier market conditions. Wide divergence in the vacancy rates going into the pandemic, going into this big increase in work from home. Chris, what is the situation in Europe and how does that compare to elsewhere in the world?
So Europe entered the pandemic from a very low starting point of vacancy levels following several years of robust demand and limited development, as well as some conversions to other uses, particularly residential in markets such as Amsterdam. But since the onset of the pandemic, we have seen vacancy rates rise for offices across the board, primarily driven by the release of second-hand space. But nevertheless, vacancy rates in Europe remain in relatively healthy positions, close to or below their long-term averages in most markets, and are especially low for Grade A space, where occupier demand has been focused. In contrast, vacancy rates in North America are high in absolute terms, in the high teens and even above 20% in markets such as San Francisco, and also much above their long-term averages in all markets.
Right. So big variation in terms of the conditions on the ground in terms of occupational demand and space availability as well. So the picture really it's pointing to is a cloudiest outlook for office in the U.S. And there's been a lot of discussion around what that means for real estate returns, performance of the real estate asset class. Heidi, is there any silver lining that we can point to here?
Yes, although traditional office is a much less important part of U.S. portfolios in the past, in 2019, office was 28% of real estate portfolios versus 19 this year. This lower share will have a lesser impact on overall market returns than it would otherwise. While we still continue growth in office subsectors like life science and MOBs, there is still a significant allocation to office in Europe and Asia where conditions are better. Yet the office sector will remain a key part of U.S. portfolios with repricing levels.
Another silver lining to mention is the brown to green opportunity, which is especially relevant and current in Europe, but is coming to the US and globally. As we see, much of Europe's office stock is older than 20 years and will need upgrading to meet higher standards. And this is driven both by increasing regulations, but also tenant preferences and corporate commitments towards net zero carbon. And there's mounting evidence as well to support this from a financial viability perspective, where we see increasing evidence of rental and sales premiums for buildings with green certification, as well as brown discounts for older assets.
So picking up on the big themes here, we see bifurcation by quality, bifurcation by sustainability status, whether an asset is aligned with net zero, but that is at different places of its awareness and relevance in different parts of the world, and just generally different, widely varying degrees of tightness or lack of tightness in occupational markets, and varying return to office. So it's very difficult to paint with a broad brush a global picture of office. But we hope that if you want to read more, you can go to the insight section of LaSalle.com and read the full report, where we really dig into all of that variation and try to make sense of what it means for portfolios and for investment strategy. So Heidi, Chris, Dennis, thanks for joining me today. I see we have a very, with this new hybrid way of working, we have a hybrid locations represented here, a couple of LaSalle offices, some from home. So I think that's very appropriate. Thank you, guys.